Welcome back to the Capital Mindset. I'm your host, Alex, and today we are tackling a fundamental truth in finance that, frankly, most people get wrong. We're talking about the secret behind consistent profitability. And no, it's not about being a market psychic. Joining me today to unpack this is Sarah Chen. Sarah is a seasoned financial strategist known for helping investors shift from emotional speculation to statistical certainty. Sarah, welcome to the show.
Thanks for having me, Alex. It's great to be here to talk about something that is often whispered in the professional trading world, but rarely shouted to the general investor, the risk-reward ratio, or RR.
That's exactly where I want to start. Sarah, if you scroll through financial forums, the whole conversation seems to be about accuracy. People are bragging about their 80 or 90% win rates. Why is this focus on being right actually a toxic trap for most investors?
It's deeply psychological, Alex. It taps into our human desire for validation and certainty. When people press that buy button, they're chasing the adrenaline rush of being correct. They believe that if they're profitable, they must have a high win rate. But that belief is the most toxic and limiting mindset you can ever have in finance. It drives emotional decision-making.
You call it a toxic obsession. Give us the fundamental truth that replaces that. If profitability isn't about being right 90% of the time, what is it about?
The fundamental truth is that profitability is measured not by your percentage of correct predictions, your accuracy, but by how much you gain when you are right compared to how much you lose when you're wrong. It's effective disaster management.
Right. It's like, the analogy of a top-tier chef. You can cook 10 perfect dishes, but if the 11th one burns down the whole kitchen, you've lost the entire business.
Exactly. And in finance, the kitchen represents your capital. Therefore, risk control must always precede profit projection. That brings us straight to the RR, the essential compass for navigating these volatile markets.
Core discussion: deconstructing the RR. Let's deconstruct this compass. What exactly is the risk-reward ratio, and how does a beginner actually calculate it for a specific trade?
The RR is a tactical metric that compares your potential risk to your potential gain. It's usually expressed as a ratio, like 1 to 3. The key is understanding the two R's.
Start with the risk, the left side of that ratio.
The risk is crucial because it's the only variable you can completely control. It's not your total investment, it's the maximum loss you are prepared to accept on that single trade. For a trader, this is the distance between your entry point and your stop-loss level.
That parachute, as some people call it.
Precisely. It's your parachute, and you secure it before you jump. So if you buy stock at $100 and you decide your stop loss is going to be at $98, your defined risk is $2 per share.
Okay, so that's the one in our 1 to 3 example. Now the reward.
The reward is the potential profit, defined by the distance between your entry point and your take profit level. Following that same example, if you expect the stock to reach $106, your expected reward is $6 per share. Now, if you look at those numbers, a $2 risk and a $6 reward, that's a ratio of 2 to 6, which simplifies perfectly to 1 to 3.
That's a huge shift in philosophy. Instead of asking, how much will I gain, the professional asks, how much am I willing to lose first?
Absolutely. And here's the magic. Most beginner investors think they need to win 50% or more just to break even. But think about our 1 to 3 scenario. Because every time you win 3 times what you lose when you're wrong. You only need to be right 25% of the time to be profitable over the long run.
25%. That changes the whole game. You're essentially telling the market, I'm okay with losing 3 out of 4 times, as long as the one time I win pays for all those small losses and then some.
That's the statistical edge, and that's the real magic that leads to something called positive expectancy.
Strategic fusion, positive expectancy, and the casino's edge. Positive expectancy, that sounds very professional, but what does it mean in plain English?
In simple terms, it's the average value you expect to gain or lose per trade over the long run. It's the formula that proves your strategy is financially sustainable. You have to ensure that your winning trades, multiplied by their probability, outweigh your losing trades, multiplied by their probability.
Give us an analogy to make that stick.
Think about a casino. The casino doesn't win every hand of blackjack or every spin of the roulette wheel. People walk out winners all the time, but the casino only needs to maintain a slight positive expectancy, the house advantage, in every game. Over the long run, the mathematics guarantee the casino's profitability.
So our job as investors is to become the casino, not the gambler.
Precisely. And the key takeaway here is the interplay between RR and your win rate. For example, if you are disciplined enough to target a 1 to 4 RR, you only need to win more than 20% of your trades to be profitable. That removes the pressure of chasing impossible perfection. It lets you focus on sound strategy, knowing the math is on your side.
That's powerful. And Sarah, does this only apply to short-term day traders using things like futures or derivatives? Or can this be applied to, say, a retirement portfolio?
No, RR is a capital management principle that must be applied to your entire financial universe. It applies to buying long-term stocks, funding a startup, or even purchasing real estate.
How does it translate to a long-term investor like a value investor, the Warren Buffett style?
It changes its name, but the concept is identical. For value investors, RR is known as the margin of safety, a concept popularized by Benjamin Graham. If a stock is intrinsically worth, say, $100, but you manage to buy it when the market undervalues it at $70, that $30 difference is your margin of safety.
I see. The risk is that the price drops below $70, but the potential reward is it climbs back to its intrinsic value of $100 or even higher.
Exactly. You are seeking an RR of 1 to 5 or more. You're trying to minimize your risk of loss on the downside, your purchase price, while maximizing your reward to the full potential of the asset. The macro picture even matters. When the Fed raises interest rates, it forces risky investments like stocks to offer a much more attractive RR just to justify the risk of buying them over a risk-free treasury bond.
That connection is fascinating. Now, let's turn to the emotional part. You mentioned earlier that the RR is an exercise in psychological mastery. Why is it so hard for people to stick to their defined ratio?
It comes down to one of the strongest biases in human psychology, loss aversion. Our minds are programmed to feel the pain of a loss twice as intensely as the pleasure of a gain.
I know that feeling. You see a green number on your screen and you want to lock it in immediately. You see a red number and you hope it'll come back.
That's precisely how it manifests and how it destroys your RR. You have two destructive habits that emerge from loss aversion: letting losses run and cutting profits short.
Explain how that hurts the ratio.
When you let losses run, you move your stop loss further away, or you remove it entirely. You are literally increasing your risk because you don't want to admit you were wrong, worsening your RR from maybe 1 to 3 to 2 to 1. That's the first disaster.
And the second, cutting profits short.
You see a profit, maybe you're up 2R on a trade that was supposed to go to 3R, and you close it because the fear of that profit vanishing is stronger than the desire for the full gain. You've just reduced your potential reward, worsening the ratio. Over time, these two habits completely undermine your long-term positive expectancy, even if you're great at analyzing the market.
That's a powerful lesson. It sounds like the secret isn't a complex math formula. It's the discipline to follow the simple math formula.
Absolutely. A famous Wall Street trader used to say that his job was not to predict the future. His job was simply to ensure that when the market proved him right, it paid him a fortune, and when he was wrong, it only charged him a small fine. His secret was an unwavering RR of 1 to 4. It was pure discipline.
That brings us to the practical application. For the listeners who want to apply this right now, what are 2 or 3 actionable steps they can take to optimize their RR immediately?
The optimization happens by simultaneously increasing your reward and reducing your risk. So first, make your stop loss technical, not emotional. The stop loss should not be based on the amount of money you're willing to lose. It should be based on what the market is telling you. Place it at a level that, if hit, invalidates your investment thesis, like just below a key support level or a critical moving average. This reduces your risk to its most logical expression.
That's smart. The market tells you you're wrong, not your wallet.
And second, set strategic take profits and stick to them. The take profit should be placed at a level where the price has historically met resistance. Realistic targets improve your overall win rate, which works in tandem with your RR to boost your positive expectancy. Don't let greed move your target, and don't let fear make you close early.
That's smart.
And finally, try the double RR trick. This is an advanced move.